So we have talked about the four forms of business combination. We have also talked about the acquisition method. And then the question is, how do the form of business combination affect the way that the acquisition method is applied? If you still remember that the four forms of business combination, the first two forms are statutory merger and statutory consolidation. And under these two forms of business combination, at least one of the firms will dissolve, and there is only one surviving firm. So for example, A obtain control over B, A survive and B dissolve. And then as for the consolidation, or in other words, as for the acquisition method, there are four questions we are going to talk about. The first question is, what do we do on from A's book? The second one is, what do we do on from B's book? How about on consolidation worksheet? And what do we do going forward? So if it is under the dissolution situation, on A's book, what we do is we record a journal entry. Basically, we're trying to move firm B's all of its asset and liability just physically to firm A's book. And then we close out firm B's book. The journal entry we do here from A's book is we debit all of firm B's assets at the fair value of those assets. And we credit all of firm B's liabilities at the fair value of those liabilities. We credit the consideration transferred by A from A to B at the fair value of the consideration transferred. And then if there's a difference between the consideration transferred and the fair value of firm B's net asset, we either debit a goodwill or credit gain on bargain purchase. So that is the general entry we make on firm A's book. On firm B's book, as I just said, that we're going to close out firm B's book because B is dissolved, it is no longer exist. And then the consolidation worksheet. So because we have already closed out firm B's book and we physically moved all of firm B's assets and liabilities to firm A's book, so actually there's nothing need to be done regarding consolidation worksheet. There's no need to do the consolidation worksheet, so we don't need this step. And going forward, because at the date of acquisition, we already closed out firm B's book. So going forward, we don't really need to do anything going forward. All of the account balances are physically consolidated at the combination date. So there's only one firm going forward. There's no consolidation needs to be done going forward. So in other words, that if it is in a situation that dissolution takes place, there's only one surviving firm. Consolidation is only done once at the date of combination or at the date of acquisition. Nothing needs to be done going forward. It's just a one-time thing. And this is the only journal entry we need to make. Or maybe there's a second one, we need to make another journal entry to close out firm B's book. And that's it. So this is the first kind of situation for statutory merger and statutory consolidation. And then for the other two kinds of business combination, acquisition of more than 50% of voting stock or control through ownership of variable interest. If you still remember that in these two situations, there's no dissolution takes place, both firms survive. So again, if A obtain control over B, both A and B survive. And what do we do in these four places? So first of all, on firm's A's book, now we also need to make a journal entry, but it's slightly different from the previous journal entry. So we credit consideration transferred at the fair value of the consideration transferred. And instead of moving all of these assets and liability to A's book, we just debit an investment account for whatever is the fair value of the consideration transferred. So this is the journal entry we make on firm A's book. And then on firm B's book, we actually, in this situation, because firm B still survive, so we don't need to close out firm B's book. Instead, we do not do anything on firm B's book. So firm B is not really firm B is just continuing operating as if nothing happened. And then on the consolidation worksheet, what we do is we take firm A's book. So at the end of the financial reporting period, we take firm A's book, we take firm B's book, we make some consolidation entries, and then we add them all together, and that will give us a consolidated total number. And this number is what we report to investors. So if you pull out a firm's 10K report, if it is a publicly listed firm, you are probably going to see its balance sheet, income statement, and the other statements is all consolidated balance sheet, consolidated income statement, which means that the numbers you are seeing on firm's 10K report, they are taken from this column. You are not really going to see the parent's book. You are not going, the numbers you are seeing are not the parent's book or the subsidiary's book. It is after consolidation, it is the consolidated total numbers. And one thing here to pay attention to is firm B's income statement accounts are consolidated only for the amount after the acquisition. So this makes sense, right? If a firm B earned some income before acquisition, that does not belong to the consolidated firm. So we shouldn't include it in the consolidated income statement. And what do we do going forward? So different from the previous situation that nothing needs to be done going forward. In this situation, we do need to do something going forward. Basically, going forward, both firm A, because both firm A and B survive, so they both keep their own books. And consolidation is done periodically on the consolidation worksheet, which means that every period going forward, we need to do this, we need to make this consolidation worksheet again and again and again for every period going forward. So consolidation is basically done on the consolidation worksheet, and we need to do it every period going forward. So this is the second kind of no dissolution situation. And then I want to talk a little bit more about this. We're going to see some examples later, but I just want to talk a little bit more about this, what we do on the consolidation worksheet, what specific consolidation journal entries we make on the date of acquisition. So on the date of acquisition, on the consolidation worksheet, we take from A's book, we take from B's book. And as I said, we make some consolidation entries. Specifically, what consolidation entries do we make? We make two consolidation entries, entry S and entry A. What is entry S? S actually stands for shareholders' equity. So what we do using this consolidation entry is, we debit firm B's shareholders' equity account at its book value and credit the investment account at the book value of firm B's net asset or firm B's shareholders' equity account, so whatever is this amount. And we use this consolidation entry basically to eliminate firm B's beginning shareholders' equity account. And then what do we do using entry A? So entry A is, we debit firm B's asset at the difference between fair value and book value. And we credit firm B's liability at the difference between fair value and book value. And also we credit the investment account at the difference between consideration transferred and the book value of firm B's net asset. And the difference, we either debit a goodwill at consideration transferred and the fair value of firm B's net asset, or if the difference is gain on bargain purchase, we credit gain on bargain purchase. So we're going to see an example, but the purpose of this consolidation entry A actually stands for allocation. We're trying to use this consolidation entry to mark up firm B's value from its book value to its acquisition date fair value. So let me just talk more about this no dissolution situation. We're going to see an example later that may give you a better idea of what we do here. So after the consolidation, so after we take A's book, B's book, plus entry S, plus entry A, give you the consolidated totals. After acquisition, what would be the balance of firm A's investment account? I want you to take 1 minute to think about this question, and you can pause your video for now. So after consolidation, what would be the balance of firm A's investment account? The answer is 0. The investment account will go to 0. Why? Why would the investment account go to 0? So if you recall, what composed firm A's investment account? Firm A, at the date of acquisition, firm A first make a journal entry, right? To debit investment account, credit consideration transferred at the fair value of the consideration transferred. So basically, in this journal entry, investment account is increased by the fair value, by the amount of fair value of consideration transferred. So investment account is increased by this amount. And then in the consolidation entry S, what we do in consolidation entry S is we debit the firm B's shareholders equity account at its book value, and we credit A's investment account for the same amount. So basically, this journal entry will bring down firm A's investment account for the book value of firm B's shareholders equity account. And if you remember that in a balance sheet, left-hand side is asset, right-hand side is liability, and we have shareholders equity account, or basically shareholders equity, it would be equal to asset minus liability. That's why we call it is the net asset of the firm. So basically, consolidation entry S, we bring down the investment account by the book value of the firm's net asset. And what do we do in consolidation entry A? In consolidation entry A, we mark up firm B's book value to fair value, and we credit the investment account by the difference between the fair value of the consideration transferred and the book value of the firm's net asset. So in consolidation entry A, we decrease the investment account by the fair value of consideration transferred and book value of net asset. Okay, so now you can see what is the result of doing all of this. Basically, fair value of consideration transferred, those two are eliminated. And then we take out book value of net asset, but we add back book value of net asset. So that's why it will bring down the firm's investment account to 0. After all of this, it will go to 0. So this is actually something you need to check after you have finished consolidation. The consolidated total numbers, in your consolidated total numbers, your investment account should be eliminated to 0. If it's not 0, there's something wrong. You need to go back to check again. So this is about the investment account. And then there's another issue I want to talk about. The dissolution situation and no dissolution situation. In both situations, it will actually give us the same consolidated total numbers. So this is something that is very interesting. In the example we're going to look in a minute, you are going to see that no matter it is with dissolution or without dissolution, we're going to have the same consolidated total numbers. Or in other words, the form of business combination actually does not affect the total numbers, the result, or the financial accounting numbers investors are going to see. No matter what kind of business combination the firm is taking, for investors, they are going to receive the same numbers. And why is this the case? So let's, I'm going to give you, maybe please think about it for 5 minutes. And you can pause your video for now. So why would the two situations give you the same consolidated total numbers? Let's first look at no dissolution situation. So in this situation, this is actually the more complicated situation. We need to take both firms' book and to do the consolidation entries, to add the consolidation entries. But let's look at this situation for now. If there's no dissolution, both firms survive. What is happening is we take firm A's book, and then we're going to add firm, so firm A is going to make a journal entry, right? And then that will give us firm A is going to have an updated book after journal entry. And then we're going to combine it with firm B's book. And then we're going to have the consolidation entry S and consolidation entry A. So this is what we do in this situation. If we look at firm A's entry, the entry from A makes is it is going to debit investment account and credit consideration transferred at the fair value of the consideration transferred. So this is the entry that firm A makes. And then from A, so after this entry, from A is going to have an updated book after this journal entry. And then during on the consolidation worksheet, firm A is going to add firm B's book. So what is firm B's book? Firm B's book is basically B's asset at book value, B's credit B's liability at book value, and credit B's shareholders' equity at book value. So this is basically from B's book. And then we are going to add consolidation entry S. We use consolidation entry S to eliminate from B's shareholders' equity account at its book value. So consolidation entry S is basically we debit from B's shareholders' equity account at its book value, and we credit the investment account and at the book value of firm B's shareholders' equity account, or in other words, the book value of firm B's net asset. So this is consolidation entry S. In consolidation entry A, we try to mark up firm B's book value to fair value. So basically, we debit firm B's asset at the difference between fair and book value. We credit firm B's liabilities at the difference between fair and book value. And we credit the investment account at the difference between consideration transferred and the book value of firm B's net asset. And then if there's a difference in goodwill, we will debit goodwill. And goodwill is basically the difference between the consideration transferred and the fair value of the firm's net asset. Or if the difference is at the credit side, we will credit gain on bargain purchase. Sorry, it's a little bit messy here, but I think you get the message. Gain on bargain purchase for the difference between fair value of the firm's net asset and the consideration transferred. So this is what is happening. This is what is happening under the no dissolution situation. And so if you look at what is happening here, consolidation entry S, the firm B's shareholders' equity account, it is actually eliminated from B's shareholders' equity account. So those two cancel out. And then for the investment account, so investment account was decreased by the difference by book value of the net asset, and it is decreased again by the difference between consideration transferred and the book value. So those three items cancel out. And then what do we have left? So we have debit firm B's asset at book value. We also debit book B's asset at the difference between fair and book value. So as a result, what we have is a debit firm B's asset at book value plus fair value minus book value. So that is basically at its fair value. And then we credit firm business liability at its book value first. We also credit it at the difference between fair and book value. So similarly, we're crediting, as a result, we're crediting firm business liability at the fair value of those liabilities. So those items are taken care of. And what do we have for now? So we credit the consideration transferred at the fair value of the consideration transferred. This item is taken care of. So this is taken care of, this is taken care of, this is gone. And what we have left now is goodwill and gain on bargain purchase. So if the balance is at the debit side, so we either have a goodwill at the difference between consideration transferred and fair value of the firm's net asset, or gain on bargain purchase for the difference between fair value of the net asset and the consideration transferred. So, and then if you look at this journal entry, what do you find? This journal entry is basically the firm's journal entry when under the dissolution situation. Or in other words, as you can see that what firm does under the dissolution situation is actually, it can be broken down into what the firm does under the no dissolution situation. Basically, all we are trying to do here under the no dissolution situation is we use entry S, entry A, the entry we make from A's book. All of this is just to give us the same consolidated total numbers as if the firm is using the dissolution, is under the dissolution situation. So, so this is a brief overview of how the acquisition method would differ under different forms of business combination. And then we're going to look at some specific examples.